Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. As always, this is just for educational purposes and is not investment advice. In today's video, we're going to look at Medtronic stock, and we're going to try to estimate where the stock will likely be in 4 years from now if the trend of the past 7 or 8 years continues. This article is out on Seeking Alpha now, and I'll have a link in the description if you want to go read the article. I'm just going to kind of scroll through it to prompt me and remind me what to talk about. And so let's get into it. So now the idea behind this analysis is it's an earnings-based analysis. So we basically want to think of if we bought this business as a business owner, how much earnings we would likely collect during this time. And then as a second step, I'll say, well, how much do we think the market would be willing to pay for those earnings on average based on history? And then I'll compare those results to the S&P 500 index estimates or a cash equivalent. And so we'll have some different ways that we can look at this to try to figure out where the stock's going to go and whether that is potentially a good investment based on other options, common options like the index or cash. So the first thing I always check whenever I do an analysis like this, well, actually, let's start here. So I've done analysis on Medtronic before. About 3.5 years ago, I was the only author to write a sell article on Medtronic in like a decade on Seeking Alpha, because the valuation had just gotten really extreme and it wasn't likely to produce good returns now over the medium and long term. And we're getting into the medium term when we're 3.5 years later now. So it takes a while. Usually it can take longer or shorter periods of time, but usually I find within about 3 years, the prices revert. But over the longer term, that whatever the earnings trend is usually what the price eventually starts getting pulled toward. It's kind of like a magnet. So now Medtronic had some issues with COVID and things like that. So that explains kind of this gap here right after the 2020 pandemic started. But what doesn't explain that is the movement since then, since late 2021 when the price has fallen. So since I warned people about it, it's down about 14%, while the S&P 500 is up 46%. And this includes dividends. So we can see that in the past, even if you account for the pandemic, people were just paying way too much for Medtronic back then. So I'm kind of revisiting it now that the price is lower and the earnings are actually a little bit higher than they were 3 years ago, I think. So we can see where it's at, where things stand now, and that's what I'm going to do in this article. Now, in the past, I've looked at kind of 10-year CAGR expectations, but in this new series that I'm doing, I'm focusing on 4-year returns. So it's a little shorter time period, a little easier for people to wrap their mind around, and it's also just the returns that I expect. And so it's a little more straightforward and easier to measure. So that's kind of the goal that I'm aiming for with this new series. So let's get into the valuation. Now, the first thing I like to check is the long-term earnings trend. So if we look here, this green shaded area are the historical earnings for Medtronic. And you can see, and what I'm looking for here is how much they fluctuate, how cyclical they are. Sometimes I'm looking just for unusual patterns. I've looked at so many of these over the years that I can just a lot of times I can just look at a chart like this and I can be like, oh, this probably happened here, this probably happened here, and I don't even have to really dig into it very much because I've done it so much, and most of the time I'm pretty close to being right. So these guys have grown earnings really steadily and experienced almost no declines in earnings per share, and then they had a couple rough years here. Okay, that's expected, that's a pandemic. If I move my face over a little bit, you can see that this year is the one that's kind of the outlier from historically speaking. This should not have really been a year where earnings growth declined. So that helps explain this gigantic sell-off. It's down 37% off its highs, along with the fact that it was just extremely overvalued at the time. But what I'm looking for here is to see if there are drawdowns over 50%, and none of these are even close to that. So as long as the earnings drawdowns and if the earnings are fairly predictable and the drawdowns are less than 50% historically, then it's okay to use an earnings-based analysis most of the time. So if they are deeper than that, then I would use a different sort of analysis, and maybe I'll just give an example here. So let's say this was Valero or something like that, which I've made videos here about before using a different strategy. Okay, see these gigantic drawdowns, right, in earnings, and then this year is going to expect it to be even more. So that's the type of thing where earnings would be too cyclical and you wouldn't want to use the type of analysis that I'm going to use for Medtronic. Okay, but still a good company. You just have to analyze it differently. All right, let's get back to my article here. So we're good in terms of the historical earnings trend. It looks like a pretty high quality business. Since I'm using earnings per share, I always look at the stock buybacks and I make adjustments for these because these will buybacks will inflate the earnings per share over time. And I want to know really what the actual earnings are if they weren't buying back stock. If you just kept that money for yourself and you didn't buy back stock with it. That's the idea behind it anyway. So I check that. I also want to make sure I incorporate these drawdown years, okay? That kind of mimics this was an actual recession. It was kind of a weird one, but it kind of mimics like a potential future recession. And these aren't very big, so they aren't going to have a huge effect. But what I want to know is what the earnings growth rate is for this time period. And I also want to know the earnings yield given the forward earnings. Okay, so here's how it works. I look at the forward earnings expectations from analysts. So this is only 1 quarter ahead. So these are probably going to be at least roughly, or I guess it's 2 quarters because they report tomorrow. But we'll have one more reporting period until we kind of know what the real numbers actually are. So I look forward. I take these estimates up to 1 year in advance, and then this is my base earnings that I'm working with, okay? That, at today's price, that's a 16.06 PE ratio, all right? This PE ratio is the same, it's just you invert it, so you put the earnings on top of the price, so it's earnings over price, and that gives you the earnings yield of 6.23%, all right? Now, you can think of this just like a bond yield or just like a savings account yield with one in terms of your estimates. I mean, it might not actually work out that this is the case, but you can think of it that way. And then what you want to do is take what you think those earnings will grow at, and I use mine based on history, which I have at 1.87%. So I think we have an earnings yield of 6.23%, and that will grow at 1.87% for 10 years. That's how I calculate this. So the way to think about that is if you bought this whole business for $100, okay, it would pay you $6.23 per year if earnings didn't grow at all, right? But earnings are probably going to grow. And so I include this growth rate in, and I usually pull forward the first year. So I'll have this plus 1.87% for the first year, and then I'll grow it for 10 years after that and see how much money we get. So that's what I do in this article. Let me move myself again. And so I explain all that here. And then I break down so you can see how much you would theoretically earn each year. This is how much you would earn, see, and then it grows a little bit each year. And this is how much you accumulate. And then when you get to the end, you have $69.04 plus your original $100 that you started with. All right? So when you put this in a Kager calculator, you put it in as you start with $100, you end with $169.04, and it will spit out a percentage here of your compound annual growth rate. And so this is what I use to calculate what we could expect to happen in 4 years. Okay, if this is kind of the average, this is just what we're going to use to estimate what the stock price could do over the next 4 years. Pretty simple. So if you take it and you compound it at that rate in 4 years, if sentiment remains the same, people feel the same way about the stock as they do now, in 4 years you will have earned about 23%. Okay? So what we want to do is compare that return to what it would be if you invested in the S&P 500 using the same method, or you invested in cash, which is what T-Flow is, my cash equivalent here. So doing that, we can see that it basically is going to expected to earn about the same if the market is treating the stock the same and feels the same way. It'll probably earn 23%, S&P 500 maybe 27%, cash about 17% because it's yielding in between 4 and 5% right now. So given the fact this is over 4 years, I mean, we're talking like single digit differences. It's basically market performance if nothing really changes in terms of the way people feel about the stock. Now the next section, I say, okay, well, what if people do change how they feel about the stock and they change it to how the market kind of normally feels about the stock market returns over the very long term, which is about a 7% 10-year CAGR, okay? And that's the same as about an 18 PE growing at 10%, okay? That's kind of the assumption that I'm making here, that that's what the market will tend to price things at, which is more conservatively than they're priced now. So before, where the S&P 500 was expected to rise like 27%, if it has a mean reversion, it will probably only rise about 13 or 14%. So that's the difference. And if that happens to Medtronic, since it's still kind of richly priced relative to what the market tends to pay over time, it would actually be about flat. It would lose a little bit over 4 years per year. So you could expect to lose like 5%, including dividends, over the next 4 years if the market kind of reverts to average. And while the S&P 500 would rise 13%. So the difference here is like 1,800 basis points. And then the difference to cash is like 2,200 basis points, okay? So now we're seeing more of a difference. We can tell that it's probably overvalued, but not like crazy overvalued. And these are all just estimates. So the threshold that I'm using in order to call a stock a sell, where you have kind of, where you accept that these are just estimates, we don't know exactly what's going to happen, is like 25% or 2,500 basis points. And we're below that compared to cash still. So I would say it's probably still a hold, and I'm not confident enough, or I don't think it's just totally clear that that it would underperform by a lot, enough for me to rate it a sell. Now, if earnings remain how they are now, and they might not since they report earnings soon, but if they generally remain close to where they are now, and the price goes above $88 per share, that would be enough to get this over 25% difference or 2,500 basis point difference, and then it would be a sell. So that's how I think about this. And I like to generally assume a historical mean reversion rather than assume everything's going to stay how the market feels right now, especially since interest rates are rising, and they're rising toward more normal historical levels, okay? So everything to me seems to be pointing to the idea that it makes more sense to take just kind of a long-term historical average when we're evaluating stocks. So I have a big section where I explain all the ratings, including the one that I just explained to you. And I'm going to track these results and see what happens over the next 4 years to see whether I'm right or not. So I would expect after 4 years that this would be pretty close to what cash would yield and what the S&P 500 would yield. Maybe a little bit lower than both of them, but it's definitely within same margin. But I also break down some buying levels if earnings remain similar to what they are now. So above $88 would be a sell if earnings are roughly the same. If it gets below $62, that would be a buy for investors who are just trying to find something that will probably outperform the market, but not necessarily have a big margin of safety and not necessarily be aiming for really big returns like I aim for. So for me, a strong buy would come in at $45 per share. And that's when you could expect to make like 15% a year for several years, on average with a stock like this. If and there's no guarantee the market will provide that price, probably won't. I'd say the odds are low. But I would buy other stocks, instead, unless it fell down below that level, while earnings were similar to now. Now, if earnings fall, these numbers would all come down. So if they disappoint on earnings in a really big way, then you could expect these numbers and these thresholds to come down a little bit. All right, so I'll have a link to the article in the video description if you want to read through it and read all the reasoning and everything behind it. And my plan is to put out a lot of these analysis on individual S&P 500 stocks. And then we're going to track the results over time, and we're going to see kind of how it breaks down, whether you can actually kind of use earnings to evaluate the medium-term returns for stocks like this. Thanks for watching, and I'll see you in the next video.